So welcome back to Top M&A Entrepreneurs. Today I have my bestie back, Holly, CFO strategist, and I asked her a question about something because I was trolling Twitter and I saw this person say, you know what, working capital, you should just throw it into the loan. And I thought that has to be a problem because I said, well, let's say if the working capital is $500,000, I do an SBA loan for 10 years at 12%. What do you think the interest payments are over 10 years? It adds $386,000 of interest payments. I said, nah, this is not a way to do this. There's got to be a better way. And that's why I asked Holly back on. She's my CFO strategist. She's done this before. So welcome back.
Well, thank you, Jon. Thank you for having me. I'm excited to be here. Who doesn't want to talk about working capital? This is an exciting topic, right? So let's try to make sure that people don't hang up on us right now.
Yeah.
So if you're a seller, you're going to want to listen up because you don't want to leave money on the table. If you're a buyer, you don't want to pay more money. And whoever advice that was terrible. And we'll figure out why that is.
Great. Let's get into it. I mean, you got screen share. If you got a little presentation you want to show me after giving you 24 hours to put this together. Yeah.
Okay, so listen up. So working capital is only really necessary if you're doing an asset purchase deal. Okay, so what does that mean? There are two types of deals. Well, there's others, but there's two types of deals that mainly happen. One is a stock deal, and a stock deal just takes the seller's records and your records and they smush them together. Okay. So there's no talk about working capital. Now, most deals and most of your audience deals will be asset deals. So in asset deals, you're going to want to listen up because you don't want to pay too much money and you do not want to leave any money on the table. And working capital is part of that equation, Jon. So we're going to define it and just know whatever we're talking about here is negotiable. So we're going to continue to hit that home too. So working capital, the reason why we don't want to make anybody an accountant today, but banks look at working capital different, net working capital than, in an acquisition. So there are different definitions for working capital, but the one that counts for you today is total current assets minus total current liabilities. And the assets do not have cash included. And that's the one that in other definitions, sometimes they do. But in an acquisition, Jon, as you know, most deals, not all, but most are cash-free, debt-free deals. So what does that mean? It means that the seller actually takes the cash and pays off the debts and gets my check for that purchase of their business. And that's what they get. And so that's a cash-free, debt-free. And so if that's the case, what's happening is you're going to have and embark upon a conversation about working capital. And it's common practice for the seller to give the buyer working capital. So that's the start of this conversation. And, so in this example, we have, about net working capital of 1.9. So oftentimes, Jon, what I hear from a lot of sellers is, I don't want to give you any AR. I created that under my money. That doesn't seem fair. Right. And so let's go back to your controversial X tweet, whatever. Can you call them tweets anymore? I don't know. But your X comment or whoever was commenting about, just put it in the loan. So if you have no working capital, so imagine this. We bought the business, Jon. The seller took the cash, took all the working capital. So we have the employees and we're operating their business. Day 1, day 2, day 3, we need to pay their employees with cash. How do we do that? Well, your tweet suggested that we just go get a loan. Well, think about it. That means that you're paying more money than you thought. All that person said in that tweet was, you didn't pay X amount, you paid X amount plus the working capital it takes. So let's talk about that. Let's get to the next slide, Jon, and just go a little further in that, unless you have any questions.
Don't.
Or comments. So pull it. Let's go through all of them. All right. So So here we have an income statement that went along with that balance sheet. So we have an EBITDA of 5 million. And so we're agreeing to pay a multiple of 8. So it's $40 million. Now, this, I don't care what size business this is, the same principles I'm going to talk about exist. So it could be a smaller business and they exist. Maybe your multiple's slower, but nevertheless. So you and I are going to write a check for $40 million here. The seller, it's cash-free, debt-free, our deal. Again, you can negotiate anything. You can keep the cash. A lot of the smaller deals, you keep cash for working capital. But in our deal, it's debt-free, cash-free. So what I get as a seller is $40,300,000. So I get to get my 40 million, I get my cash, and then I have to pay off that debt on that balance sheet. Okay. So that's what that looks like. But like, how do we figure out what that working capital is? So this is how I look at the business. When you look at this business, we have 3 million in cost of goods sold and 2 million in SG&A. That's $5 million. If I divide that by 365 days, I have $13,699 per day. So every day we operate, John, we need to spend $13,699 in cash. So then the question becomes, in this business, and it depends on the industry, I just said, let's say it takes on average to get paid from our clients 90 days. Well, if you take $13,699,000 per day times 90 days is $1.2 million. So we will need another loan, to your point, John, of $1.2 million just to operate the business. If we get no working capital. Now, if you noticed in the first slide, we had excess working capital, $1.9 million. Well, if you don't know anything about working capital, because typically you're going to set a target or a range in your asset purchase agreement, because you won't know exactly what that working capital is until the day of closing. So you set a range. And so if you said 1.9 million in this particular deal, you've given too much working capital. And so you would want to negotiate that back and say, all right, if anything is above the 1.2 million, you have to pay me more money. And if it's below the 1.2 million, I have to reduce the purchase price. That's typically
that's in a
how that
clause
rolls.
in the asset purchase agreement, right?
Yes.
Yeah.
Yes, because you don't really know. So so let's think about this. So the problem becomes, so a lot of what people do is they take the average working capital. So they look at your balance sheet for 12 months, say, and they get that average working capital month over month, and then they average all of them, all 12 months.
Oh, so you got to look at the balance sheet month to month.
Month by month, yes.
Okay.
And that's typically what they do, and then they will average it. Now, here's the problem with that. Let's say in our example, we are at peak season. So that means AR is really high, right? Because we're at peak season. And let's just say that it's in our fictitious business here, it's professional hours. We don't pay overtime. So, like an accounting firm or something, a bookkeeping firm, peak hours. And so my $5 million really didn't dramatically go up. You're delivering too much working capital. So you need to be careful how that's averaged and how that's looked at if you're cyclical. That's why if you're a seller, you're going to want to get your arms around this and make sure that you're not giving too much money. And if you're a buyer and the seller says, this is stupid, I should get my working capital. Or if oftentimes, John, in these smaller deals, there isn't any working capital. Okay. And so in that case, as a buyer, I would pay, in this case, let's say they had no working capital. I would say, I'm willing to pay $41,200,000, and I would finance that. Just like you said, I'd finance it. Hopefully we wouldn't go to the bank at 12%. Hopefully the seller knows or something, but I would finance that.
Yeah.
And that is certainly something to do. But the reason why this is so controversial is because in every deal it can change. And as a buyer, sometimes I didn't always get working capital, but I knew I'm paying a fair deal. And even if I added the working capital, I always calculated, what do I think it is? Even if I added working capital, I was okay. And I felt good about that. And then when I review, did I do a good job on this acquisition after they're through the door? I would make sure that I am looking at how they're doing compared to the total price, which would include that loan. for the line of credit for that working capital. So you got to know. So the guy on Twitter, whoever that X, whatever that was, what he's talking about is really you're just paying more for the business. And sometimes that's okay, Jon. Sometimes we're going to make that decision, but it's all over the board. Nobody needs to be an accountant here. We just need to go like under the undercurrent of what's the business principle? What should I look out for? I think we have one more slide. We should just roll through that and then do some questions. One more slide, I think, where setting the target. So one more click, I think. There you go. Okay, so again, this is what I said. Typically what they do is look month over month over month. I had a client look over 2 years. We could not get to anything they felt comfortable with. We could not get to a number. So we analyzed it over 2 years and they had some cycles. And, I'm reasonable about that. I'm like, okay, well, we don't need to pay you for excess. Finally, we hit a range by looking at 2 years of working capital that they felt okay with. And we did close in the middle of their peak season. So that's another reason why we're talking about this. Like we did a range that was reasonable for us. So typically that's what the buyer's going to ask for, something like that. How I do it, and I know this is a little more accounting, but go with me here. So I actually take a look, if there's AR on the balance sheet, I'll look at how many days there is in AR. So you do that by taking your income divided by 365 days, get you your daily income, divide that into your AR of 2.4 million. In our example, it's 88 days. So it takes us 88 days to get paid. And so then I look, and just like I said before, I look at how much cost do I have per day times the 88 days is 1.2 million, target set. So sometimes what happens is this is very much an educational thing. If you are a seller, many sellers, and most of the business I was buying were in the 1 million to 5 million range in revenue. And most of them struggle a little bit with this concept. So going out and educating yourself a little bit about it and making sure you're not taken advantage of is really important as a seller. And as a buyer, know what you're buying so you can hold yourself accountable for making that return on that acquisition.
What's your experience of educating somebody? Because a lot of the times the brokers, 50% brokers are great, 50% of brokers are not so great, kind of like doctors. 50% graduate in the bottom half of their class. How do you go about educating, like, this is how much you're going to take all the cash out, but we actually need this much in for working capital? How do you educate? How do you approach them and go about that?
Yeah, you think about that because I'm the buyer, so I've already have a conflict of interest, right? And so education could be looked at as manipulation, right? Okay, so I got to go back, right? Okay, so I got to go back to, first of all, acquisitions are about relationships. So we need to establish relationships and trust. And I don't surprise anyone at the APA, at the asset purchase agreement. I don't surprise a seller. Because if you think about this is their biggest transaction of their life. They don't know what's common practice. This is common practice, right? We're not talking about anything that anybody's trying to pull the wool over anybody's eyes. So what I do is I back the train up to initial conversations saying, this is what's expected. Are you aware of this? And then I'll send articles and things for them to educate themselves. Because again, I could be looked at as a conflict of interest, but hopefully I have enough trust and relationship that they're okay with me by the end to say, yeah, that makes sense. But I've struggled with it, to be honest. I mean, it hasn't been a perfect, and depending on somebody, some people are more skeptical than others. It's just the way it is. And so getting a broker to help out if they have one. I've bought companies that didn't have brokers. Okay. So they were, that was, I'm the educator, but I think no surprises at the end. That legal agreement should just be, yep, we talked about this. Yep, we talked about working capital. Yes, we talked about, all the things that get people worked up, non-compete and all the things, right? We've talked about that. So there's no surprise then. That's how I do it.
So the ways you can do this are, or what you'll see is most of the SMB sellers, they'll take all of the cash out of the bank and then, or you borrow it on the top and pay, for example, if it's $500,000, interest payments are $360,000 over 10 years, which is $860,000 added to your bill. or leaves it in. That's great. Or you peg it at a range. So
Yes, yes. And the reason why you do that is usually marching down to close. And I've seen this before. What the buyer doesn't want you to do is strip down those assets, right? And so what do I mean by that? What I mean by that is I've had situations where the buyer really legitimately thinks that I created this AR, it's mine.
yep.
I don't care what everybody says. And so they start collecting it early. They issue a discount to pay early, and they strip it so much that, again, surprise buyer, you have to go get a loan to pay for working capital because there's nothing left. So they peg it, they put it in the agreement. And, I like a range, whereas if it's in the range, nothing happens. And then the price is adjusted one way or the other if it's below or above the range.
Beautiful. God, I love this conversation, Holly. There you go.
Who thought working capital would be so exciting?
This is such a sticking point. Well, Holly, thank you so much. How do I get in touch? How does anybody get in touch with you if they don't understand this?
Okay, that's awesome. Well, find me on LinkedIn under Holly Moini, Moeini. Same for my website, same thing. And Holly is with a Y. No, or with an I, not a Y. Did I say a Y? Okay, I can't even spell my name. All right, Holly with an I, not a Y. Okay, so there we go. Thank you, Jon. You know what? It's always great having me on here. I love it. Thank you so much. I appreciate your audience. I appreciate you.
Thank you.